let me start with the story that everybody knows. The Three Little Pigs. One built his house out of straw, another built his house out of sticks, and the third one built his house out of gold bricks. Now, when the weather was calm, all three houses looked fine. Nobody questioned the structure. Nobody was asking what the house was really made of. But then the wolf showed up. And when the wolf started blowing, the truth came out. The house made of straw collapsed first, then the house of sticks. Only the house made of gold bricks was still standing, and more importantly, protected those who owned those gold bricks. The story is not really just a children's fable. It's also a perfect picture of the modern financial system, because today we have built a massive financial house of paper claims, leverage, debt, derivatives, securitized products, collateral values, and confidence. And from the outside, it looks incredible. I mean, watch what's happening. Wealth seems to grow and grow and grow. Asset prices keep rising. Balance sheets get bigger. We now have the first trillionaire. And with these mega IPOs, I'm telling you, we'll have a lot more trillionaires right behind Elon Musk. So, woohoo! Everybody celebrates. Happy days are here again. Don't worry about the little consumer at the bottom. No problem. But here is actually the problem. A house can look very impressive from the street, but still be out of straw. And when the wolf shows up, it does not care how big the house looked. It only cares about what the house was made of. So what is the financial market made of? A really wonderful viewer asked what collateral was, and that was a perfect opening to come in here and show you. Because what's the wolf in the markets? Well, it's the Collateral Doom Loop. So if you haven't watched that video yet that I recently did, we're putting the link below. Make sure you go and view it. But you'll see the falling collateral values are the first gust of wind. Margin calls are the gale force, and forced selling is the typhoon. That is how the system goes from calm to crisis. Not because everyone wants to sell, but because leverage forces them to sell. And when that happens, you find out very quickly which houses were built from straw, from sticks, and which were built from gold bricks. So let me show you the collateral that is in the system. And we're going to start with this global liquidity hierarchy. This is the big picture. And what you're looking at is an upside down pyramid. At the top, you have the largest layer, derivatives, notional exposure. That means that nobody really knows the true value that's at risk. But this is synthetic liquidity, made up out of thin air, and all of the financial claims that sit on top of the system. That, my friends, is the straw. It looks enormous. It looks powerful and liquid, but most of it is not real settlement money. It's just a chain of promises, and it is one party's asset and another party's liability. It is a claim on a claim on a claim. Now, look, I understand that not every derivative settles at once. That's not the point. The point is that the top of this pyramid is very large, larger than anybody can possibly imagine, very leveraged, and very, very dependent on confidence. Under that, well, what do you have next? You have private business, commercial real estate, residential real estate, non-monetary commodities, and digital assets. That is more like the house of sticks, because there really is real value in there, because there are real assets. But in the modern system, those assets are also collateral and turned into products. And that means that people borrow against them. Institutions lend against them. And then funds leverage against them, which means debt upon debt upon debt. And when those values fall, that weakness moves through the entire system. Then we move down to securitized debt and stocks. These are assets that can feel very liquid when markets are calm, and they can be bought and sold quickly and easily, and they can go up fast, and they can also reprice or go down violently when that liquidity leaves. Below that, you have sovereign bonds, government bonds, and treasury bonds, the foundation, or what people are led to believe is the foundation of the system. This is where the system says, here's safety. Governments want you to believe that their debt is risk-free. I'm sorry. 10 trillion times zero? It's still zero. Well, then we go down to the physical currency. In the US, physical notes are only about 2.7 trillion. That means all of this stuff out there. That's tiny by comparison to the paper claims above it. And finally, at the very bottom, we have physical gold and physical silver. Those are the bricks. Now, physical gold and physical silver may look small compared to the mountain of paper claims above that. And let me tell you, we can't even see all of those claims. That's from the government numbers, but However, both gold and silver are used in every single sector of the global economy. Those paper claims, one place. These are real. Physical gold and silver in your possession, they are real. They are not a promise or someone else's liability. And importantly, they do not need a counterparty to perform. In fact, the BIS, the Bank for International Settlements, states quite clearly that gold held at home is the only financial asset that runs zero counterparty risk. And that's the lesson. At the top of the pyramid, the numbers are bigger, but the claims are weaker. At the bottom, the numbers are smaller, but the foundation is stronger. When confidence is high, people chase the top. But when the wolf shows up, frankly, they run to the bottom. Now, let's talk about what happens when the wolf actually starts blowing. This is the collateral doom loop. Step 1, collateral values fall too fast. That could be stocks, real estate bonds, private equity, derivatives, digital assets. I mean, it could be anything. And while we're taught to think of those intangibles as assets in the financial system, they're also collateral. That changes everything, because when something is used as collateral, that means that some bank has borrowed against it and another has lent against it and leveraged it possibly many, an unlimited amount of time. So when collateral falls, it does not just hurt the person who owns the asset. It threatens the debt, the margin account, the derivative exposure, and the lender on the other side. Remember, they're all incestuously intertwined. And that leads to step 2, which is the margin calls, because those require even more sales to meet. And this is where most people misunderstand market crashes, because they think that they sell, or people sell, because they want to sell. But in real stress events, people often sell because they have to sell. They need cash to meet those margin calls and reduce that leverage in order to satisfy lenders who need to protect their balance sheets. So what happens? They sell what they can sell. You ask me why gold and silver are dropping? It's not gold and silver that are dropping. Those users, 36, 33, they didn't disappear. What's dropping are the contracts. Because when everybody needs liquidity at the same time, guess what? Boop! That liquidity disappears. And that leads to step 3, which is forced selling, which overwhelms the liquidity. Prices fall, collateral market values fall, margin calls increase, more selling hits the market, buyers step back, liquidity gets thinner, and prices fall again. That's why it's a loop. That's the doom loop. And this is why the fable matters. The house of straw does not fall slowly. When the wolf blows hard enough, it collapses quickly. That is how leverage works. Everything looks stable until suddenly, boom, it's not. And that is why liquidity is so dangerous to misunderstand. Liquidity is always there when nobody needs it. But when everybody needs it all at the same time, the exit door gets very small. Ever tried to borrow money from a bank? Takes forever. It's a pain in the neck. When you don't need it, they'll give you all you want. But when you do need that liquidity, boop, it's taken away. Now, this is probably one of the most important slides in this presentation because it's the heart of the message. Here we can see what synthetic liquidity actually is. It's derivatives, rehypothecation, shadow banking, repos, ETFs, stablecoins, all of these intangible layers of claims. But they're also layers of engineering, very complicated engineering, layers of access, which, as we've seen, if they permit you to have access, they can also take those access away. Ask any private equity investor that's tried to pull their money out recently. These are also layers of convenience. In normal times, they work. I'm not saying every financial product is bad, but what I am saying is this: do not confuse access with ownership, or a statement balance with your ability to access that balance. Do not confuse a price quote with liquidity or a claim on wealth with wealth itself. Because in a crisis, the system runs out of trusted assets. And in its flight to safety, the real questions emerge. Who has the collateral, or who only has a promise? That's why this slide is so important. You have this huge stack of synthetic claims, and beside it, this teeny tiny block of physical gold and physical silver. That is the picture of the financial system. A giant house of paper promises, claims on nothing, sitting on a very small base of real settlement assets and real claims on something. And again, when the sun is shining, the house of straw can look impressive. It can be tall and complex. It can be profitable. It can attract attention. But when the wolf shows up, complexity is not strength. It's actually just the opposite. And leverage is not safety. And confidence, that's not capital. And a promise is not the same thing as a payment. And frankly, that brings us right back to the 3 little pigs. That straw house looked just fine. So did the stick house. That brick house looked fine, even though it was smaller. Then the wolf showed up. And that is the financial system today. Most people are looking at account balances, retirement statements. They're watching things, cryptocurrencies and stock markets go up. They look at real estate estimates. Look at how much my house is worth. Market prices, digital numbers on a screen. But I want you to ask a deeper question. What are those numbers actually built on? Are they claims or promises? Are they leveraged? Do they depend on liquidity being exactly when you need it? That is why you need physical gold and silver as a proper diversifier and your wealth insurance as a foundation, because they are the bricks in your possession. They sit outside that promise system that has to give you access in order to hold your wealth or access your wealth. You do not need a bank, broker, exchange, or government promise to make these real, because physical gold and silver in your possession are not someone else's liability. So here's the question I want to leave you with. When the wolf shows up, do you know what your house is made of? Because the top of the pyramid is big and impressive, and it looks like it controls everything. But the bottom of the pyramid, that's real. And when the confidence breaks, capital does not run to what looks biggest. It runs to what still stands. Thousands of years of proof. That is why the Zang International Sound Money strategy is built on physical gold and silver, because they are real, tangible assets that sit outside of that promise system. You don't need permission when you're holding sound money. Not paper gold, not a claim, not somebody else's liability or promise. Physical gold for opportunity and wealth preservation. Physical silver for barterability and day-to-day flexibility. And a strategy that includes surety in food, water, energy, security, barterability, wealth preservation, community, and shelter. It's designed to help you build your house with gold and silver and food and everything else that you need before the wolf is at the door. And I know that together we can do anything. So if you found value in this, make sure you give us a thumbs up, leave a comment, subscribe, and share. This is important. And until next we meet, please, wherever you are in the world, be safe out there. Bye-bye.